Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at Zoom Video Communications Incorporated, ticker ZM. There's some good and some bad here. This is a stock that looks like it's half price right now, coming up with a fair value of 112, current value of about 60, and discounted cash flow is 116. So in the low hundreds is where we are coming up with the stock fundamentally, although with this thesis, it is coming up with a pretty low growth rate at 3.8%, which is somewhere between 1/2 and 1/3 the returns that you'd expect from the market overall. Fundamentally, very sound company. Earnings yield 3.09%. That is good. We'd be looking for earnings around $3 for what we're currently paying for the stock, and they're coming in around 5. So definitely looking good on the earnings front. Cash flows, super strong cash flows. 32.5% have traditionally been around 36.8%. So down a little bit, but very, very, very good cash flows. ROE is pretty good at almost 8%. ROI is even better at 9.6, and ROA, lowest of this group, is still pretty good at 6.4. Debt to equity is 0.24. Margins 76 and 14. Fundamentally, this is a very, very solid company. I have nothing to complain about any of these fundamentals. Only thing that I could complain about is the growth rates for things. And as we get into that, revenue analysts are expecting 2% and 2.8% over the next 2 years. For growth, we're going to go with 2.5 for our thesis. Share count, and they have been growing their share count quite a bit in this last year, probably aided in the drop of the stock. But I'd like to see them get back to 1%. We're going on the higher end, saying 3%. I mean, if we do go 1%, things adjust and do look quite a bit better. But we do want to be pretty reasonable. So 2, 3 after what they've done this last year would be pretty fair. Cash flows, I've got them growing a little bit faster than the revenues are to bring that cash flow yield back up to 33.3%. Assets, they've been strong on asset growth. 9.6 is the lowest that we've seen out of them. So 10% is definitely fair. Liabilities, they didn't take out a whole lot of debt over the last 2 years and actually shrank it over the last year. So 1 is a pretty fair number. It's probably higher than what we're going to see out of them, but we'll see. It looks like they're probably issuing shares and using that instead of taking out debt. They don't pay a dividend. Margin, they were a bit below average, so we can definitely get that back up towards the 18.8 that we've seen out of them. And what that gives us is buying at today's share price, assuming a 3.8% annual growth rate in the fair value. In 3 years, we're going to have a fair value of $146, which is 144% higher than the stock sits today. So very solid returns if the market understands the fundamental value of this company and doesn't discount it because of the low growth rate. And similar story for the 5 years, we're looking at $155, which is 159% growth over the price that you're paying today. So I was really surprised when I was looking into this one. This is probably one of the better companies that we've taken a look at. Fundamentally, super solid. I do want to readjust this share count back down to 1% just to see. That 5.2 does help us out quite a bit. In that case, you're not underperforming the market by quite so much. It's less than half now. So I'd be much more comfortable with something like this. But the story here is they have a whole lot of cash. We're talking the difference between the market cap and the enterprise value of this stock is huge. Current price is, let's just round it to 60. If you factor in all of the cash and debt that they have, you're looking at cash per share of somewhere in the realm of $15 to $16. So you're getting a massive margin of safety, a huge discount on the stock, and they do have cash to deploy to higher margin portions of the business or even buying up other companies, which is probably what they're going to need to do, because some pretty big competition from both Microsoft and Google, and honestly Apple too, that they're going to need to find a way to differentiate themselves and diversify a little bit. And that's probably part of why they're so discounted, because the market doesn't believe that they have the ability to do that. Analysts, at least in some form, believe that they can drive slightly higher revenues. This thing was a monster back during COVID. It hit a peak over $500, and after that was just on a massive 2-year downtrend and is finally flattening out around the $60, $70 level. Down 10% over the last year, 16% year to date, almost 7% in the last 3 months. And they're actually up in the last month, week. Today, they were up 3%. But they have earnings in 2 days. So I am recording this before earnings, and I think I might buy some. I'm debating on whether or not to do a leap or to buy some shares. I wouldn't go too heavy on it because it is, well, because of the reasons that I covered. I wouldn't want to put too much money in that sort of risk. But I definitely want some sort of exposure to it before these earnings. When we look at everything graphed out, earnings have been all over the place. They had really good earnings back in 2021, and this year's expectations are in the realm of what they had back in 2021. So we'll definitely have to see how those play out. But the balance sheet has been on a nice upward trend. Cash flows have been flowed a little bit, but relatively flat. Dividend is non-existent, and then the actual share price, just you see how high it was, and it's crashed down, and it's now lagging behind every valuation metric. And it really has been since late 2023. I definitely feel like $100 is a reasonable value on this thing. So once you factor in your margin of safety, you can take an even larger one with the low growth that you expect from it. And even then, I feel like you'll come up with the conclusion that it's at a good price right now. They've got so much cash that you've got an even larger buffer. You're basically getting shares for $44 because of the enterprise value. You just have to trust management to properly allocate those dollars. But that's what we're looking at for this one. I like it. Super solid fundamentals, probably one of the better ones that we've ever looked at. Just low growth. If they can deploy that cash and get some of these metrics up just a little bit to what we've seen previously, because cash flow yield is down, as is the net margin. Even being down, they're at really good spots. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.